In this chapter, you tied together the entire journey of how real estate rights are transferred from one party to another through written agreements. You began with the most familiar instrument, the standard real estate contract for sale, and then moved into deeper layers. Detailed contract provisions, option to buy agreements, and contracts for deed, agreements for sale. Each topic built on what you already know about contract law, adding new tools and new ways that buyers and sellers can structure transactions when traditional approaches do not fit. You first saw that the contract for sale is the backbone of the typical transaction. It is a bilateral, executory agreement where buyer and seller mutually commit. The buyer promises to pay, the seller promises to convey title, and both must perform by closing. You learned that this contract is created through offer, acceptance, delivery, consideration, and signatures, and that once signed and delivered, the buyer gains equitable title, the right to receive legal title at closing, and to seek specific performance if the seller attempts to walk away. The contract also organizes key concepts like earnest money, escrow, contingencies, and default, turning negotiation into a clear legal roadmap for closing. From there, you moved into the internal structure of a modern sale contract. You examined primary provisions that must be present in every enforceable agreement, including precise identification of the parties, a legally sufficient description of the property, the purchase price, and terms of payment, loan approval, and financing contingencies, earnest money instructions, closing and possession dates, conveyed interest and type of deed, and the title evidence the seller must provide. You saw how closing costs and prorations are allocated, how risk of loss is assigned if the property is damaged before closing, and how default and remedy provisions protect both sides. You also studied secondary provisions that manage inspections, association disclosures, environmental concerns, surveys, rental and tenant issues, federal lending requirements, foreign seller withholding, and tax-deferred exchanges. You learned how merger clauses, notice provisions, time is of the essence language, counterparts, and addenda, such as lead-based paint disclosures, all work together to keep the agreement clear, enforceable, and compliant with state and federal law. Next, you extended your understanding of bilateral contracts into the special world of the option to buy. An option to buy is a unilateral contract at first. The option or seller is bound to sell at agreed terms if the optionee, buyer, chooses to exercise the option within a defined period, but the optionee is not obligated to buy. You learned that a valid option must be in writing, describe the property, specify the option period, state a definite purchase price or clear method of determining it, and include separate consideration, option money, that is usually non-refundable if the option is not exercised. You explored how options are used in lease option arrangements, development deals, and investment scenarios, and how they create an equitable interest that is often recorded to put the world on notice. You also distinguished true options from vague agreements to negotiate and compared options with rights of first refusal, which give the holder the first chance to buy only after the owner decides to sell and receives an acceptable offer from a third party. Finally, you examined contracts for deed, also known as land contracts, installment sales, agreements for deed, or agreements for sale. In this structure, the vendor, seller, finances the buyer by accepting installment payments over time while retaining legal title. The vendee, buyer, takes possession and acquires equitable title, with the right to receive legal title when all contract terms are satisfied. You saw why this arrangement appeals to marginally qualified buyers who cannot get conventional loans, and to sellers willing to act as lenders and possibly spread capital gains over multiple years. You learned that contracts for deed must clearly state the price, down payment, interest rate, payment schedule, balloon payments, tax and insurance responsibilities, and default and remedy terms. You also explored the significant risks, the vendor can still encumber the property. Underlying loans might go into default, and harsh forfeiture clauses can strip buyers of both possession and equity if enforced strictly. Modern legal trends in many jurisdictions move toward foreclosure-like protections and rights to cure when buyers have built substantial equity. You close this section by reviewing best practices such as using attorneys or approved forms, recording the agreement, using escrow and title services, and carefully analyzing underlying financing. Taken together, this chapter showed you that conveyance contracts are not just paperwork. They are the operating system of real estate transfers. Whether the parties use a standard purchase agreement, a finely tuned set of provisions and addenda, an option to buy, or a contract for deed, each structure balances risk, allocates responsibilities, and defines who holds which rights and when. Review summary. In this chapter, you learned that every real estate transfer begins with a legally enforceable agreement that satisfies the essential elements of contract law and the statute of frauds. You studied the contract for sale as the central instrument, granting equitable title to the buyer and guiding the transaction from offer through closing. You explored how contract provisions, primary and secondary, shape the deal by specifying parties, property, price, financing, earnest money, escrow, title evidence, closing details, property condition, inspections, association disclosures, environmental risks, rental issues, and federal and state compliance requirements. You then examined option to buy contracts, which grant buyers the right, but not the obligation, to purchase at a set price within a defined time, in exchange for separate consideration. You saw how options create equitable interests, how they are recorded, and how they differ from rights of first refusal and non-binding letters of intent. You also analyzed contracts for deed, where sellers finance buyers directly and retain legal title until payments are complete, while buyers hold equitable title and possession. You learned how these agreements can solve financing challenges, but also create serious risks related to forfeiture, underlying liens, and the vendor's continuing power over the title. Across all topics, the chapter emphasized that clear drafting, proper use of standardized forms, accurate disclosures, careful attention to contingencies and remedies, and understanding of local law are essential to protecting clients and maintaining professional standards. Discussion. How do the concepts of equitable title in a standard purchase contract, in an option to buy, and in a contract for deed relate to each other? Answer. In a standard purchase contract, the buyer's equitable title arises once the contract is fully executed and delivered, giving the right to receive legal title at closing. In an option to buy, equitable interest arises when a valid option is granted and consideration is paid, giving the optionee the right to convert the option into a bilateral purchase contract. In a contract for deed, equitable title arises when the buyer enters the agreement, takes possession, and begins payments, giving the right to receive legal title only after the contract is fully performed. In all three cases, equitable title represents a legally recognized future ownership right that courts will often protect. Why is it critical for a licensee to understand detailed sale contract provisions rather than relying on the form will take care of everything? Answer. Standardized forms are helpful, but they are only as effective as the person using them. A licensee must understand what each clause means, how provisions interact, what rights and obligations they create, and what may be missing for a particular transaction. Without this understanding, an agent cannot explain risks to clients, cannot recognize when an addendum or modification is necessary, and may expose the parties and the brokerage to disputes, non-compliance, or unintended consequences. In what situations might an option to buy or a contract for deed be more appropriate than a traditional finance purchase? And what is the trade-off in each case? Answer. An option to buy may be appropriate when a buyer wants to control a property while completing due diligence, improving credit, or selling another asset, or when a developer needs time to investigate feasibility before committing to purchase. The trade-off is that the buyer pays non-refundable option consideration and may end up not buying. A contract for deed may be appropriate when a buyer cannot qualify for conventional financing, but can make regular payments, and when a seller is willing to finance and delay receipt of full proceeds. The trade-off is that the buyer does not receive legal title until paid in full and faces heightened forfeiture and title risks. How does this chapter reinforce the importance of referring clients to legal and tax professionals in complex or creative transactions? Answer. This chapter shows that options, contracts for deed, complex addenda, and financing structures can trigger significant legal and tax consequences that go beyond a licensee's scope. Questions about enforceability, forfeiture, foreclosure rights, capital gains treatment, installment reporting, and federal compliance cannot be fully answered by a real estate professional. Referring clients to attorneys and tax advisors helps protect the client, the licensee, and the brokerage, and demonstrates professionalism and ethical practice. Closing remarks. Conveyance contracts are where real estate law meets real-life decisions. In this chapter, you moved from simply filling out a purchase agreement to understanding why each type of contract exists, what legal interests it creates, and how it shifts risk between parties. Whether you are guiding a first-time home buyer through a standard sale, helping an investor structure an option, or evaluating the risks of a contract for deed, your value as a real estate professional is directly tied to how well you understand these tools. The better you know the contracts, the more confidently you can explain them, spot problems early, and work alongside lenders, title companies, attorneys, and tax professionals to bring your clients safely to closing. As you move into future chapters on market economics, valuation, financing, investment, tax, and risk management, remember that nearly every concept will eventually be expressed and enforced through a written agreement like the ones you studied here.